QE. The Queen's English? No, this week we're talking about quantitative easing. You're listening to episode 179 of the Property Podcast. I'm Rob B. With me is Rob D. And we've got a cracking episode coming up.
A cracking episode about some kind of arcane macroeconomic principle, I hear you say? Well, yeah, actually, it is pretty interesting. We've just been, well, if you're anything like us, we've just been nattering about it for ages before hitting record. We think it's interesting, and whether or not you agree, it affects you. So that's why we're going to be talking about it. And it affects property specifically as well. So that's what we're going to be talking about in this week's episode. But before we get to all that, the first thing to quickly announce is we've been talking about our first ever Northern Summit recently on the podcast. We've been asking you to vote, and we have a winner. You should have received an email about it by now if you're on our list, but the winning city was Manchester. So the heart of the Northern powerhouse powers on, narrowly edging out Leeds. Nottingham had a late rally as well, but Manchester is the winner. So if you want to come and join us in Manchester, emails have gone out. By the time this podcast goes out, there may or may not be places left. But if you go to thepropertyhub.net/summit, you can find out all about that, and we'd love to see you.
And don't worry, if you're in London or in the Southeast and you want to join us on a summit, our final one of the year is in October as well, and tickets for that are now on sale too, and you can check the details out at the same place. So get along to that link and have a look. We'd love to see you there. And I'd love to see a few of you at RMP soon. What am I talking about? Well, there's a new role and opportunity coming out, and I've advertised this role before, being vague, but deliberately so. I've advertised this role before and met hundreds and hundreds of people and only managed to take one person on because I just couldn't find the right type of person. So one day it dawned on me, the type of person I'd like to hire is probably somebody who listens to the Property Podcast or reads the magazine or contributes on a forum or all of that. So I'm not going to advertise this role through the normal job channels. I'm hoping that the person who's right to work for RMP and get involved in all the things we do is already listening. It might be you right now, or it might be someone you know. So more on that next week. But I'm pretty excited about and kind of gabbling on this new approach because last time it really didn't work because finding the right type of culture fit is difficult. But if you listen to this, then you already are the right type of culture fit. So more on that next week. And I promise there'll be a lot more information.
Yeah, exciting stuff. Mysterious, Mr. B. We will see what all that is about next week. Just before we get to the main topic, one more quick announcement. This is something you'll want to know about as well. We're holding a free webinar on the 7th of September at 6 p.m, and it's about Brexit and what comes next. So we've had so many questions about Brexit. We've done a couple of episodes on it, but as the dust settles, what happens next? And this isn't just going to be about Brexit. It's going to be about interest rates. It's going to be about QE, all the kind of things that we're talking about today and have talked about recently, getting into all of it together to tell you what the coming years look like. There's going to be no sales pitch whatsoever. We're not going to start with 20 minutes of telling you how great we are. It's going to be a webinar of pure content. It's on the 7th of September, 6 p.m, and it's limited to 100 people. So if you'd like to come along to that, make sure you get in quick. The link to do that is going to be in the show notes, which are nice and short this week, thepropertyhub.net/QE.
But magazine subscribers, you've got a little extra bonus because we can only have, because of the software, 100 people attend, and we're going to have more than 100 people try and attend. So if you do intend to join this and you're not a magazine subscriber, sign up, but make sure you jump on the webinar early, otherwise you might get locked out the room because only 100 people can get in due to the software. But because of that, and we know it's going to be oversubscribed, we are holding one at 7 p.m, for our magazine subscribers. You don't have to do anything. We'll send you an email, and we will probably carry on doing these for our magazine subscribers in the future as well. So might be something worth considering if you haven't signed up yet, which just must be a lapse in your greatness, because that's what all great people do, is sign up to the magazine. But if you are a magazine subscriber, it's something we're going to carry on doing more of in the future. We're going to open this one up to everyone, but as I say, it's limited to 100 people. It's going to be really, really good. And actually, Rob says we're not going to sell anything, but we're actually going to do the opposite. And we'll probably end up giving some stuff away at the end as well. So we kind of the anti-webinar where you turn up, learn a lot, and get given stuff. Bit different, but I'm sure it'll be popular.
Yep, should be. Okay, so let's, without further ado, get into our topic of the week, which is quantitative easing, henceforth QE, and how it affects property. So this is a topic which is worth knowing about. And how much you want to know about it is kind of up to you. But you need to know, if nothing else, what effect it's likely to have. Because whether you know about it or not, it's happening, and it's happening in a big way, and it's going to have an effect on everything that you do. If you're investing in property or interested in doing so, which presumably you are, or you're really listening to the wrong podcast, it's definitely going to affect your how investments perform over the coming years. So what we're going to do in this episode is talk a little bit about what it actually is and do our best to explain it, and then spend the rest of the episode, the bulk of the episode, talking about what's going to happen as a result. So let's start at the very beginning then, Rob, with what has happened, why we're talking about this right now.
Before we do, I want to make a bold prediction that this will, although it's not the sexiest of titles or headlines, a bit like our inflation episode, again, on the surface not that exciting, I think this episode will be one of the more popular ones, but we'll see. Because a lot of people understand what quantitative easing is, and don't worry, we'll go on to what it is now, but really the impacts of it, that's what makes it so interesting. So the Bank of England announced a few weeks ago that they're going to stimulate the economy through a number of measures. So they talked about chopping interest rates, but one of the measures, of course, was more quantitative easing. We've done it before, we stopped it, but we've started again. And the Bank of England have committed to another £60 billion worth of quantitative easing. And that process has already started. So they announced it a couple of weeks ago, but they've already started. Now, most people think quantitative easing is money creation, which it is, sort of, but it's not physical, is it, Rob?
No, basically what the Bank of England does with QE is create money. So just create money on a screen. But then if they just do that and they say, great, the central bank's now got more money, that doesn't do any good because it just sits there and there isn't actually any benefit to anyone. What they need to do is get that money out into the economy. So how they do that is take this money and go out and purchase assets. So they'll go out to institutions like pension funds and buy assets with this money that they've just created. So as before, you just had, say, a government bond being owned by an institution, the central bank goes and buys that with the newly created money. So now the institution has the money and the central bank has the asset. So what you've done is created the amount of assets in circulation. So this new money is now sitting in the bank account of somebody who can use it. So in theory, they can actually go out and do something useful with it. So what it is just finding a way of getting more money into the economy. And we'll link to a video put together by the Bank of England that explains it. It is actually relatively simple. It might not sound it from the way I've just described it, and the name makes it sound really complicated, but actually it's relatively straightforward to get your head round.
Yeah, a lot of people, and we do from time to time as well because it's easier, say we're printing money, but there's no physical money printed. The majority of money is actually digital. Depending on what stat you read, anywhere from 95 to 97% of all money is actually digital. Only a very small proportion of it is physical money. But as Rob mentioned, we'll link to a video. It's fairly simple stuff. It's a short video. It's from the Bank of England. Go to thepropertyhub.net/QE. Nice and simple this week. Thepropertyhub.net/QE. And you'll be able to get that link and many of the other links that we'll talk about. So we understand what it is. It's reasonably simple to understand. But as I mentioned at the beginning, what it does is really interesting. So what we need to do now is look at how it will affect the property market. Because it really does affect the property market. It affects a lot of things, but it really does affect the property market in a big way. So quantitative easing helps lower the yields investors can get from the bonds. Because if the Bank of England goes and buys a lot of bonds, then the yields are less. They go down because lots of people are buying. So the bank goes after these so-called safe assets. So that makes them less attractive to investors because if you're getting zero return pretty much on a bond or even a negative return, then there's no real appetite to go in and buy bonds. People are put off from buying them. So what it does is it makes them less attractive. And that encourages those same investors, to go out and put their money in slightly riskier things in search of better returns on their investment.
And one of those things that they go out looking for is property. Another one is stocks. And so it's no surprise that since QE came about, global stock markets have been doing really well because effectively you're creating money and that money needs to go somewhere. So it flows into assets like the stock market and like property. QE therefore has a direct impact on pushing property prices upwards because increasing the money supply is inherently inflationary. You create money, the money has to go somewhere. So it flows into things like property. Therefore, QE pushes up property prices. It also pushes down the cost of borrowing because you've got all this money now sitting in banks. They need to lend it out. The whole point of QE is that it actually is used to do something. If it just sits in the bank, it's not doing a lot of good. So it pushes down the cost of borrowing, which in turn encourages people to borrow money to buy property, which pushes property prices up again, and so on, and round it goes. So this sort of leads us on to the next point, which is whether QE is a good thing. Whether it's good kind of depends on your definition of good. Like you could say that as a property investor, yes, it's good because it means that your borrowing cost is reduced, so you can go out and buy more, and then you can expect the value of what you already hold to increase, which makes you wealthier. But that is, of course, a very limited view of things.
It is, and not everybody thinks the form of quantitative easing we're using is a good thing. So in the last couple of weeks, there's been a letter put forward to the Chancellor by a group of economists, and basically they're saying, you've gone the wrong way this time. So in the letter, they say, after the '08 crisis, QE and the form of QE we've used was absolutely the right thing to do. Well, they wouldn't probably put it that strongly, but they agreed. They couldn't argue against it too much. And it seems right. We needed a shock to the system. We needed money in short term to help the economy. However, as we said, quantitative easing inflates asset prices, property being one of them, very much so. But what it does is it makes the rich richer and the poor poorer. We'll look at some of the stats in a minute, but the Bank of England themselves have conceded that this is true. This is a consequence of quantitative easing, that people who are able to buy assets will be made wealthier by quantitative easing, but people who can't afford to buy assets and are trying to save are punished. The Bank of England believe it's a price worth paying, and this short-term shock is needed. We'll come to the alternative shortly, but it will make people feel uncomfortable. If you're a property investor, you might be comfortable with this and go, well, I'm going to make money, I'm fine with it. But is it right for the society as a whole that property prices are going to boom because of this? It's debatable.
Yeah, and it's making the rich richer and the poor poorer is really the key part of it. And in the show notes, we will include a table, which is, I just found it absolutely fascinating. It's showing what's happened to various asset prices since 2009, which is when we sort of started having the first rounds of QE. And when you look at how different things have performed, it makes really clear who the winners are. So since 2009, the stock market is up by 87%. Great if you own stocks. House prices are up 32%. Great if you own property. Mortgage rates are down 30%. Also great if you own property. Inflation has been 16%. So any returns lower on 16% on assets you hold are going to leave you poorer in real terms. So what has performed worse than 16%? Well, pension annuity rates down 27%. So if you're coming up to retirement and having to buy an annuity, you are worse off, significantly worse off than you would have been before. The total return since 2009 of cash in the average deposit account, 5%. So what's this telling you? Well, it's saying that if you're on a fixed income, or if you've just got cash in a deposit account and not much in the way of assets, which probably is the majority of people, you are worse off than you were in 2009. If you happen to own property or stocks, you are a lot better off than you were in 2009. And this is where you can say, okay, you see what QE is trying to achieve, but is it doing it in the right way? The New Economics Foundation published a report that made the point that 40% of the stock market is owned by the wealthiest 5% of the population. So the gains here are very, very unequally distributed. And they also make the point that the QE is not really finding its way to productive parts of the economy. So they estimate that the 375 billion of QE that happened up until the current round increased GDP by about 1.5% to 2%. So basically, they've taken 375 billion and turned it into about 23 to 28 billion of extra spending in the real economy. What's happened to the rest of that money? Well, it's sitting in the financial system, enriching the balance sheets of companies and individuals who are doing fine anyway. And it's only a tiny fraction which has actually trickled down and done anything helpful to boost demand in the economy. So that is really the data behind the assertion that we made earlier about it making the rich richer and the poor poorer.
So what's the alternative? Well, the group of economists I mentioned earlier have proposed an alternative. And that alternative is spend the money on infrastructure instead. So take that money, that's 60 billion, and go and build HS2 and HS3 and fund it straight away. So it creates jobs, it improves the infrastructure of the UK, it'll have huge economic benefits. You know, it would make a huge change to the country. That would fund it, all of it, straight away with just this one tranche of QE. Instead of buying some bonds. Let's face it, there's enough going on to push property prices up already. QE, okay, it's going to push it up further, but we don't need it. The infrastructure and paying for it this way would be a really, really interesting concept. But for some reason, the government, the Bank of England, they're just not interested. So we have to look at why. Why are they not interested? Why would they not do this instead? What's stopping them?
Well, the answer to that is effectively the timescale over which it has an effect. So the current method has an instant impact. Over the course of a couple of months, they can go out and they can inject lots of money into the economy. And in theory, that money then boosts demand and gets things going and has a positive effect on GDP and staves off any recession. Infrastructure projects will be better in the long run, but it won't have any instant effects. Now, to an extent, it is important that you have an immediate effect because it does ward off a recession and you do need things to happen now. And confidence is such a big part of it. So people see things going well, it creates a virtuous cycle and it means that you don't have to have this stimulus for such a long time. But in another way, it's like, yes, you're basically shocking the system, but without any great long-term benefits and potentially long-term pain. But in another sense, it's storing up long-term consequences. That's the price of this short-term gain. And you could also be cynical and say, well, what's the point in having a benefit in the future when there might be a different government in charge who'd take the credit for this great new infrastructure project? We've seen this before, haven't we? Short-term gain, longer-term pain. It seems to be a bit of a theme, and this short-term is a problem. It does seem like the central bankers are doing everything that they can to get things going, and it hasn't really worked. So interest rates have gone all the way down to effectively nothing. They're pumping in more and more and more money, trying to get a short-term effect. It's debatable about the extent to which that has actually been effective. And then as a result of all this, it's storing up all these long-term consequences that we won't see for potentially decades. We've seen this before, and this does seem a little bit like it's just more of the same thing.
So QE, it's going to boost asset prices, it's going to reduce lending, it's going to pump property prices upwards. You may agree with this, you may not. There might be better ways, that's possible. But really, it doesn't really matter how passionate we get about this because this has happened, we can't change it, you can't vote to change it. You can either decide to be punished by it, which some people will, or take advantage of it. Now, that might sound a bit cold, but if you understand what's going on, then you can make manoeuvres and you can take action. The whole point of this episode is to inform you so you can do something about it. We want you to understand and tell people what's happening, educate them so at least they can save themselves. If you understand what's happening, then even if you're not quite in a position to invest right now, you can make sure you work hard to get in a position to invest so you can start to take advantage and move yourself on the side that's moving upwards and not the side that's falling away. Personally, I've talked about this a lot. The article on the disappearing middle classes, we've talked about that on the podcast as well. It's not something I I agree with. I'm quite passionate against it, actually, the other way. But now we know what's happening. The more people that understand what's happening, the more people that understand what's being created, well, we can make sure we're on the right side of that path and make sure we take advantage of it. So right or wrong, that's up to you to decide. But, there's no point in getting angry and then decide to get punished by what's happening. You may as well take advantage of it if you know what's going to happen.
So there's lots of things going on at once here. We've talked about QE. That has an effect on inflation. It has an effect on the cost of borrowing money. It's tied into interest rates. It's tied into asset prices. All this stuff is going on. At the same time, you've got Brexit, and who knows what that really means and how that will affect things. And then there's also the whole confidence piece, which really is the driver of everything anyway. All this stuff is going on at once. What does it actually mean? What should you do as a result? Well, that is why we're holding this webinar. So we can go into all of this at the same time. All these things that we've talked about in the past across separate episodes, we can tie all of them together into one webinar. We can have some visuals as well, which are really helpful when you're talking about this kind of thing. And we can talk about what's going on, what's likely to happen next, and how you can position yourself to take advantage of it. Because as Rob said, right or wrong, it's happening. So if you want to position yourself so you're likely to benefit from what pans out over the next few years, then you can do so. If you don't feel comfortable doing that, then you don't have to. But if you want to, that's what the webinar is going to be all about. So the webinar is going to be on the 7th of September at 6 p.m. It is limited to 100 people, so it will be oversubscribed. So if you're a magazine subscriber, you'll get a separate email with a link to a special session, which is just for magazine subscribers. But otherwise, the link for everyone else is going to be in the show notes for this episode at thepropertyhub.net/QE.
Remember, you will be able to request a place, but on the evening, only the first 100 will get in. So please don't tell us off if you can't get in on the evening. It will only allow 100 people in physically to the software. So you could register, but if you turn up 5 minutes late or 1 minute before it starts, you might not get in. So if you do register, make sure you turn up a bit early, click through the link so you've grabbed your place. For magazine subscribers, as Rob said, don't worry, we'll email you the links and we've got a slightly separate time for you, and we'll send that very, very soon. Right, we've got a really good resource of the week coming up, and we're going to let you know about next week's episode. But before we do, we have to have a round of applause, please, for this wonderful individual who's left us a review. And Mikey S69 says, over the last couple of years, I've been through several personal setbacks, and I found myself at crossroads in life, not knowing which road to take. By chance, I stumbled across your inspirational podcast back in September 2015, and only today have I finally caught up to the latest episode. Needless to say, the extensive and free information you provide has helped me confidently purchase my new home, releasing equity to fund my next property investment, which is due to begin very soon. Thanks to you both. I've clear focus and vision for myself and my children. Thank you so much and keep up the amazing work you do. Wowzers, that's quite a review. Thank you, Mikey. That is awesome. I'm glad you appreciate it, and I hope you take advantage of the free webinar we're putting on in the next few weeks.
Well, let's see if we can follow that up with a cracking resource of the week. And this week, Rob, you've picked out something I wasn't aware of, which is Google Inbox.
Yeah, I don't know how this one, it's sort of crept under the radar, this one. So Google Inbox, so you may be familiar with Gmail. Well, Google have got an alternative. So we'll link to it in the show notes at how you can find out more about it. But they've really redesigned email, I suppose is the best way of putting it. There's lots that it does. I'm not going to go through it all. It groups emails so they're easier to go through. You can leave to-dos against certain emails. You can highlight them. I know you can do that on other ones. One of the features I really like, though, and a resource of the week we've previously talked about, is Boomerang, where you can say, send this email away and bring it back to me in 2 hours or 2 days, whatever you want. That's part of the new Google Inbox. So you don't need an extra tool. It's all integrated. Looks really good. I've put it on my personal account for now, and I'm playing with it, and I've been playing with it last week, and I really like what I see. And I may even bring it over to the business account soon, because it really seems the business. It really seems really good. It's exactly what you'd want from an email. It kind of, for me, I hate looking at my inbox because it's scary, but it kind of makes it less intimidating. And of course, being from Google, it's free, so check it out.
Well, if it cuts down the amount of time spent doing email, that can only be a good thing, because it frees up time for doing more interesting things. So something I'll definitely be checking out. Also worth checking out, we hope, will be next week's episode of the podcast. So we're going to be back next Thursday. We're going to be talking about how to buy an HMO. HMOs are a really popular topic, of course. We've talked about them in more general terms in the past, but next week we're going to be talking about how to buy them, like how much you should be paying, what you should be looking for in terms of licensing requirements, where you can and can't buy them. All these kind of things we'll be getting into next week.
Okay, so before then, make sure you grab your place on the webinar. We made it nice and easy for you. You can go to the show notes, which are thepropertyhub.net/QE. 2 letters, couldn't get easier. Or you can go direct to thepropertyhub.net/Brexit webinar. That's Brexit, not breakfast, or anything that sounds similar. Brexit webinar /Brexit webinar. Or just go to QE, it's a lot easier.
But we wanted to have an option for people who really like typing. So there you go. You got 2 places to go for that. But however you do it, make sure you get there. It's going to be a good one. We'll see you again this Tuesday for Ask Rob and Rob, which is going to be a good one as well. But until then, have fun. Enjoy your week. We'll see you very soon. Bye-bye.
Bye-bye.
Thanks for listening to The Property Podcast. For show notes, all our past episodes, and to leave a review, go to thepropertyhub.net/podcast.